All right, good morning, everybody, and happy Hump Day Wednesday, February 12th. We are going to get started in a couple of minutes here. If you guys can let me know, for those of you guys that are in here already, how the audio and visual is, that would be awesome. And then we're going to get started here in just a couple of minutes. We've got obviously some knee-jerk reactions to the CPI report, and we'll see if that gets things moving. We're going to start off looking at Bitcoin this morning because I think we're going to start to get some risk on, risk off measurement there first, and maybe confirmed, I should say, from other parts of the market. We'll look at Tesla as well. I actually need to write that down. And that'll be great. Okay, let me check where we are. All right, perfect. Yeah, thank you for the audio and visual test. Again, maybe a couple more of you can just make sure that you guys are good on audio and visual. Then we are going to get started here in 1 minute or so. I'll quickly check one more thing. All right, here we go. I'm just looking at a note. There you go, 15%. All right, let's get started. Yeah, very good. All right, good morning, everybody. And again, thanks for being here. This is our Set the Market Morning Show. Serge Berger here from The Steady Trader. We are going to look at sort of the top things that we're looking at here today for sort of top of mind as far as research and trading and investing is concerned. So let's get started. If you haven't done so here, if you're here for the first time, please make sure you subscribe to the channel. You give us a thumbs up, like very important, because it allows us to continue to do this morning show, and for you, very importantly, so you get updated in real time when we're going live. So if you haven't noticed yet, this is a market that is different from the past couple of years, and we think we're really just at the very beginning of it. If you look at some of the movements underneath the surface, this becomes more apparent than if it's just if you're just kind of looking at the S&P. But let's get started and look at this. First thing, what I'd like to just quickly show you is what the futures look like. So I'm going to quickly bring this down, and you'll see that it's actually a whole lot of nothing, but let me quickly show it to you here on this chart. This is the intraday chart. So basically the S&P 500 futures are just back to where they were a number of days ago. Like it's not like we're falling apart. However, we rejected the upper end of that trading range once again this morning. So the S&P futures down, let's call it 1.1-ish% this morning on the back of CPI, in case you're just waking up and noticing this. CPI came in at 50 basis points hotter than anticipated. You know, our higher inflation for longer theme is playing out. Right, we've had a lot of people that haven't really wanted to listen to that because they believe in narratives that are being spun on TV or somewhere else. But you know, the higher for long inflation theme is here, and it's not going to be a straight line. It'll be, you know, sort of ups and downs. But for the most part, the higher inflation for longer theme continues to play out. So if we take this morning's move lower in the equity market in the S&P terms, which I'll get to the max heavens in a minute, because more and more of them are breaking down. And what that gets us to is SPY somewhere around, you know, let's call it 600. That's basically where it was a few days ago, and we have once again rejected the upper end of that range. I know a lot of people on TV, you know, they listen to the one guy that's bullish. They bring him out every day when the market's up by a tick. You know who I'm talking about. I don't want to mention his name. You know, that guy's never seen the market, doesn't make him a bad analyst, but it makes him someone that it really just only is bullish like ever. And I'm not talking about for the past 10 years. I'm talking about for the most of his career. So we need to understand when things become different. So when we look at things that are happening right now, and we use our market rover to measure and map these trends, but more and more of these trends are starting to look much more in jeopardy. So from a momentum perspective, whether it's Apple, whether it's Meta, um, whether it's sorry, not Meta, Alphabet, um, Microsoft, a lot of these guys, like I think 5 or 6 out of those 7, are essentially breaking down. And it's not like they're breaking down entirely, but what's happening is money's being rotated into other parts of the market. So if you look at what the Hang Seng did overnight, which is the Chinese large caps in Hong Kong, they're up 2.64%. You know what's not up 2.64%? The S&P 500, right? So this is what we keep talking about. It's a different year this year. There's a real serious risk of a lot of people really losing a lot of money this year. The people that have bought the V-shaped reversal for the past decade, and that's all they've learned how to do. And I mean both trading accounts and certainly investing accounts. Go check your investing account. For the most part, you'd probably benchmark to the S&P, which means you have a correlation of like 1 or like maybe 0.8 to the S&P. If the Mag 7s don't go up, you're not going to make money, right? And so, you know what else is kicking the S&P 500's butt this morning, today, or this year? German DAX is up 8. It's up 10% this year, right? So I'm trying to bring this home because I see a lot of people are still, chasing narratives on Twitter that, it's just silly. And so, if you look at your portfolio and you up this year in beating the S&P, then you've done well. 99% of people are not in that camp, right? So that's why we like things like BABA. We like things like the whole China story. And we actually like Tesla on the short side. We put on an options credit spread on Tesla yesterday. If you're a credit spread authority member, you saw that one. So there's a lot going on here, and it's a very different year. So let me just quickly walk you guys through consumer discretionary. So the consumer discretionary sector, the XLY, you know how much of this ETF is based on Tesla? 15%. Okay, so you can say whatever you want about how amazing the consumer spending money and it's slowing at the margin, but Tesla's 15% of that damn sector, right? So this is not a U.S. economy is going down the tube. That's not what this is. This is a crazy market cap concentration risk. That's an potentially extremely bearish scenario. And that's what's happening. That's underneath the surface. We've been talking about this since, I think, May of last year, or maybe more, that we're seeing pension funds, family offices, people that look ahead, right? They don't look what's happening tomorrow. They look at what's happening over the next 6 to 9 to 12 months. And they've been scaling out of these mega cap tech names. And they're putting that money in other places. And you can see people are catching on now. You can see Hang Seng Index, FXI is up strongly this year. All these things that are no longer the Mag 7s. Energy stocks are starting to look better, although they're still sluggish, but I think that's going to start looking better and better. In fact, let me look at what the oil futures are doing. That's one thing I haven't checked yet this morning. On the back of the higher, oil futures is down a little bit. But what you're seeing is from a trending perspective, we're seeing improvements in things like the energy sector. So this is a really, really good spot and good time to review a portfolio. Remember, I can't give advice here. I'm not giving advice. This is purely educational. But please look at your portfolio. Please think about what's your trading strategy. If you've largely made money for the past decade chasing chart breakouts based on a few stocks or based on the correlation on those few stocks, you're probably going to have a very difficult time this year, because this year is an actual trader's market, and that very anomaly of an environment we have for the past 10 years is probably done. That doesn't mean that we can't have great bull runs in parts of the market, but that easy trade, that S&P 500 just blasting higher 25% a year, that's probably over, right? And that's enough to bring most people to their knees, and a lot of people are going to give up 5, 6, 7 years worth of profits very, very quickly. It happens very quickly, and people usually don't listen to it until they're down 30-40%, and that's probably where some people are already losing some money. A lot of people chart chase Tesla higher into the end of the year. Oh, because Elon's going to save the world. Well, you know what's happening? The stock is down 32% in a straight line. So a lot of people that did zero DTE fund and short dated weekly options got absolutely castrated on that trade, and that doesn't mean this Tesla has to go to way much lower, but this is exactly the kind of stuff we're talking about. So let's talk about Bitcoin quickly. So one of the things that I'm watching very, very closely today, I need to see if Bitcoin goes into bearish momentum. We use the trend ruler, the TSD trender. It's our momentum indicator. So far, the shares of Bitcoin, or not shares, it's essentially a commodity, are obviously down, but they're not out. So from a momentum perspective, it's just choppy, and there's not a whole lot going on here yet, but I want to watch it very closely because it is likely going to be a signal of maybe the equity risk premium going up, meaning equity markets going down somewhat. And so I just don't see a whole lot of reason to be getting into new bullish positions from a trading perspective in Bitcoin. From an investing perspective, I personally think it's a good diversifier to have in a portfolio from an educational perspective. But I would watch this very, very closely. I think if we break 90,000, you could start to see animal spirits wake up and potentially start selling more positions down. So what to do in a day like today? Well, again, not a whole lot is happening. The S&P is down 1%. That's not much. That's back to where we were a handful of trading days ago. What I would look for, as far as, let's say, the SPY goes, if that's what you're looking at, I would see how we act around 590. I'm not saying that's today's business, that right now the S&P is going to open up around 600. The SPY 590 is probably on the SPY a level that's the midpoint of the range that we have been in for basically since the election, right? So if we break below that, then the next stop becomes the lower end of the range, and when we go below there, it's probably closer to the mid 500s, which for a lot of people is going to feel like the end of the world because everyone's levered up on the same stocks, unknowingly, by the way. And so we want to watch for that. In the meantime, we are going to remain very constructive on things that are basically not the Max 7 stocks. Again, the Hang Seng Index up this morning 2.6%. Alibaba hit our $115 price target yesterday, and a bit more overnight. So that's what's going on. Last but not least, as a fixed income guy, I'm always going to be watching yields. Yields are obviously up sharply this morning, as one would expect. That's really what's driving the equity market. So I'm not quite sure this is a level where equities are going to freak out. But I think if we push towards 5, because a lot of people have set their borrowing rate around 5%, a lot of corporates. So if you start getting above into the high 4s and the 5s, you get to a point where the equity market might start to take a bit of a beating. A bit more, but that's aside from other factors. It's not there's really what makes it difficult, I think, for a lot of people right now is that everyone's talking about how great the economy is. We've got a new president, they're doing all sorts of things and moving fast, and that makes bullish headlines. That's not the problem, I don't think. The economy is not falling off a cliff. The problem is the concentration risk. And when you have the higher inflation for a longer theme, and again, 10-year now back at 4.6 this morning, and it becomes apparent that we may have higher interest rates for longer, and the trade is very crowded, it takes very little for that to snowball, and that's really what I'm trying to get people to understand. So if there are no questions, we're going to leave it here. This was a sort of a rapid fire 15 minutes. Again, it's a wonderful time to review your portfolio, call your investment advisor, and God willing, I hope you have one. If you are a home gamer and you're a do-it-yourselfer, better have a plan, a repeatable process. We're trying to do our very best in this morning show to kind of make sure you have a process. But again, this is no longer I'm going to buy Microsoft because it's down 15% and it's going to go back to all-time highs after I take a nap. That's not where we're at. This is a different environment. I'm not calling for market crashes. That's a very different point, right? But I can tell. Even just by the lack of a lot of questions, I can see that people are a little bit frozen here, and that's because we've had a 10, 15-year bull run with no volatility and the S&P clipping 15% annual returns. That's not normal, right? So a lot of people have kind of gotten a bit brainwashed and used to these returns. When we talk to clients every week, people are basically expecting 20% returns in their portfolio. Good luck with that. And so I think what you can hope for is this market finding some sort of feat whenever it has a drawdown of say 10 to 20%. Again, we're not calling crashes, just mean reversion. If it doesn't, and the algos jump on top of each other because the Max 7 stocks are everything, you could have much gnarlier drawdowns of 30% easily. It's not even a question. I don't think a lot of people are prepared for that. I think most people are not willing to accept that. Tesla's down 30% in a few weeks. I just want people to be open-minded. That's what this is about. This is about being open-minded. So we'll be back here tomorrow morning. We'll see you guys over in the Trade Ops chat room. I think we've got a bunch of trades setting up here this morning. And any questions, please let us know. Please make sure you subscribe and you hit the thumbs up like. That way you are aware when we go live. We're probably going to go live quite a bit the next couple of weeks when things become a bit jumpier in the market, which I fully expect to be happening here as we head into, let's see, the options expiration for the month of February is actually next week on Friday, to the 21st of February. I would expect things to become a bit jumpier there. So hope this is helpful. I'm not trying to scare anyone, just trying to be realistic. I know most people are. It's not resonating with people because they don't want to believe it. But if your portfolio is moving in lockstep with the S&P 500 as purely from an educational perspective, I would urge you to start considering something a bit differently. Hope it helps. See you guys back here tomorrow, and I'll see you guys over in the Trade Ops chat room in about 15 minutes. Take care.